Wouldn't want to invest as successfully as Warren Buffett? Well, not many people, I suspect. The so-called sage of Omaha is now an octogenarian and has been declared in the past, 2008, the world's richest man, chairman of Berkshire Hathaway, a company that makes investments and has basically made Warren Buffett very rich. He's famous for early stage investments in Coca-Cola, Gillette, Amex, and plenty of other household names. So who wouldn't want that kind of track record, and how would you go about getting it? Well, today's video is how you can basically learn from Warren Buffett. It's quite difficult to be Warren Buffett in today's market, so you don't want to believe anyone who says you can be the next Warren Buffett, because frankly a lot of his gains were made in the early days. He's now so famous it's difficult for him to move without other investors leaping on his every word. He has to time his investments quite carefully, because otherwise the word gets out that he's about to invest and everybody rushes in, and you get a kind of self-fulfilling prophecy in a way that I don't. All right, when I find myself a nice little investment, the only person who gets excited about it is my mum, and she doesn't know anything about it anyway. So how do you invest like Warren Buffett? Let's have a look at his key investing principles. All right, we're not trying to turn you into Warren Buffett. We're saying there are clearly some valuable lessons you can draw from his letters to shareholders over the years as to how he goes about it. All right, so we're going to focus on one particular aspect of Warren Buffett's investing style. It's called, not surprisingly, his rule number one of investing, and it's very simple. It's this: don't lose money. And being an amusing chap, his rule number two of investing is see rule number one. All right, now the reason it matters is down to maths, and then we'll talk about how you do it. All right, why is it so important not to lose money? I mean, it sounds ridiculous to have to prove it, but it's because the losses are really, really hard to recover. Okay, just give you one example. If you currently hold an investment and it drops 30% in value tomorrow morning, mathematically you need it to rise 43% just to get back to where you started from. All right, that's the maths of losses. So Buffett was onto something when he said don't lose money. But okay, good. So how do you not lose money when you buy shares? And the answer to Warren Buffett was you look for good companies at cheap prices. And there are two vital words that go together there: a good company at a cheap price. No point in finding a bargain if it's a load of rubbish. All right, you don't just want cheap companies. Anyone can find cheap stuff that turns out to be jargon or rubbish. Okay, what you want is good companies at a cheap price. Okay, no point in buying a good company if it's expensive, if everyone else knows about it. All right, so the key: good company at cheap prices. The question we're going to focus on right now then is what makes a good company? What made those Coca-Cola, Gillette, Amex investments quite so successful? Now, you can't repeat those investments tomorrow because they've been done in one sense. Those are much bigger companies now, and maybe they're not as cheap as they once were. Maybe they don't have all these qualities. When you go rummaging around looking for stocks, trying to apply Warren Buffett's principles, what is a good company as far as he's concerned? Well, let's have a look at a few key investing lessons, investing the Warren Buffett way. Okay, so number one, you want companies with a high ROI, return on capital employed, and low debt. Now, high return on capital employed, that means they are generating annually lots of bang per buck. Okay, I'm not going to do a lot of detail on return on capital employed in this video. Have a look at my related video, what is return on equity, but here's the concept. Okay, lots of bang per buck in profit terms combined with low debt. All right, and high return on capital employed, that just means if you take from a profit and loss account profit before interest and tax and put it over debt and equity capital employed, that's the capital that's come from shareholders and the capital that's coming from lenders and banks. So 1 year's profit before interest and tax over total capital employed as a percentage, you get ROCE. So in very simple terms, if that was 100 million from the profit and loss account sterling, that was 500 million, adding up shareholders' funds and any interest-bearing debt employed by the business. 100 over 500 as a percentage is about 20%. All right, so Warren Buffett said you want high return on capital employed with low debt. So you want this to be low. So the interest bill on that debt is also low. And he's absolutely right. Right? An awful lot of banks, for example, have driven up return on equity and return on capital employed by deploying gearing, debt, not adding any value. Warren Buffett was saying it's the value you want. It's the ability to generate proper operating profits, bang per buck, not some kind of financial alchemy based on borrowing lots of money. All right. So high return on capital, low debt. Now, for anyone thinking that's a bit quick on point one, because there's more points to come, all right, take a look at my return on equity video, and also have a look at my how you can make money from gearing videos, and they'll explain those in a bit more detail. Right, that's point number one. He didn't get to be the world's richest man by just having 1 point. All right, so there are a few more tricks of the Warren Buffett trade, if you like. So there's point one. Point two, you want to find companies with predictable earnings. Now, Warren Buffett's broken his own rules a few times recently with one or two of his investments, but that's beside the point. Predictable earnings, you don't want any surprises. All right, you want companies that are going to be there day in, day out. And a feature of his portfolio is a lot of those shares have been there an awful long time. These are not fly-by-night companies that suddenly gone bust. These are not dot-com companies, for example. And Buffett famously avoided the dot-com boom and the share price rises that went with it, and also the dot-com bust and the pain that went with that. Okay, so steady, predictable earnings, and you want profits backed by cash flow. I'll put profits equals cash flow. Now, analysts rather grandly call this cash cover, but you want to check, for example, that operating profits in the profit and loss account are not a kind of accounting mirage. You want to have a look at the cash flow statement and check that the cash from operations is in line with operating profit. Okay, cash cover is the idea there's lots of cash being generated for lots of operating profits. In other words, this and this bear some resemblance to each other, and Buffett likes that. Okay, he doesn't like firms where there's lots of profit being generated and virtually no cash. All right, for more on that, see why do profitable firms go bust? Not by Warren Buffett, by me. All right, so there's number three. Number four, and only half a dozen of these, by the way, he liked businesses that were uncomplicated. Now, some would say, well, didn't he just invest in Goldman Sachs? That's fairly complicated, some would say. Uncomplicated to you, all right? There's no absolute measure here. What Buffett was getting at was you must understand the business you invest in, because if you don't, you're just playing the lottery. I mean, if you have no idea how the directors are doing it, what if they stop doing it? All right, you're stuffed, okay? So find businesses that you understand, all right? And a lot of people, it's an obvious point to make, didn't have any clue how dot-com companies were ever going to make profits, all right, let alone generate cash flow. And Buffett's point was the business doesn't have to be hugely complicated or hugely simple. The fact is you've got to understand how it's doing what it does, okay? If you're an expert in financial derivatives, you will understand those businesses and you can invest in them. If you're not, you probably don't want to bother, all right? So, uncomplicated as far as you're concerned, all right? Good example, Gillette, one of Buffett's early investments. There's a product everyone understands, and there's a product everyone's probably seen, okay? Same with Coca-Cola, all right? Then you want a strong brand coupled with pricing power. Now, I'm going to use Gillette razor blades as an example, or the ink cartridge I recently bought for my printer at home as another example of what Buffett means. Lots of things have gone down in price in recent years thanks to the Chinese. Clothing springs to mind, CDs. But anyone who shaves using Gillette razor blades, like me, will know somehow they managed to keep pulling off a remarkable trick. The price of those razor blades seems to keep going up. The little thing you attach them to doesn't. That's cheap, but the business model's clever. All right, the price of those razor blades keeps creeping up, and the way they do that partly is they say, well, you were shaving with 2, now have 3. Okay, so I'll pay more for those. All right, so they've got their ways of making sure that even in a recession, they maintain pricing power. Same with the people quite often who make replenishment cartridges for printers. The printer is cheap, try and fill it up with anything, and you end up paying an arm and a leg. And you think, well, hang on a minute, this is more expensive than it was 12 months ago. What's going on? Where's the tech revolution here? All right, those are clever business models, all right, and those are the sorts of things that Buffett was talking about. Pricing power. You can't suddenly just be undercut. And who can't suddenly be undercut? Strong brands. But you're more likely not to be suddenly undercut if you've got that sort of brand power. And Buffett likes brand names, okay? Even in the financial investment market, I mean, Goldman Sachs, love them or loathe them, has quite a brand name, okay? Now, final point, there are others we could make, but management need to be owners of the business. Not 100%. All right, it's often not possible when a stock's listed, for example. I mean, if they owned 100%, how would you ever buy into it? But the point is, management need to have a high stake in the future of the business. All right, now there's no science to this. It's a little bit art and science. There are two extremes when it comes to paying managers. You can pay them all cash, give them a massive salary, or you can pay them no salary and give them all shares or share options. Those are the two extremes, all right, and both have their drawbacks. Paying managers all in cash with no shares or share options in the business you want to buy into, they're just going to do what they need to do to earn their salary and nothing more, goes the argument. Give them all shares and share options, and all they'll do is try and boost the share price very short term, cash in and get out, all right? So those two extremes often won't work, as attractive as they might seem superficially. So there is obviously a middle ground here, but what you don't really want is management not prepared to back their own decisions with their own hard cash. Okay, so when companies take a look at the arrangement for directors, are they required to put a certain amount, a percentage of a year's salary or something, into shares by a certain time? What's the management scheme that gets them into buying shares in the company? Because if they own some shares, at least, they're likely to be more committed to doing what you want them to do, which is raise the share price, not just collect their salary and go home, if you see what I mean. All right, and there's the problem with bonuses as well. A bonus is fine, doesn't help you as a shareholder. All right, a bonus doesn't have to have anything to do with share price increases. Look at banks recently. It can simply be part of the benefits negotiated by that particular director. All right, so Buffett said, make sure that the managers are to some extent owners of the business you're buying into. All right, so there you have it. When you're buying shares, half a dozen key invest like Buffett tips. Will these half a dozen tips turn you into Warren Buffett? No. There are historical reasons why he's the greatest investor of all time. Even he's found it more difficult to make money recently, almost by dint of who he is, okay? But these will help you benefit from all of that cumulative investing knowledge and experience. And that is the way that Warren Buffett can help you in your day-to-day investing decisions.
Hey everyone, this is Kirk here again at OptionAlpha.com, where we show you how to make smarter trades. And in today's video, I just want to talk about some of the differences that you should be aware of between paper trading and real money trading. So again, with paper trading, no real money is put at risk, and that's why people really like it. It's kind of this monopoly money that you can use, hence the name, the paper money that you can trade, and it gets you acclimated to the broker platform and to the margin and to the markets. So if you're new to trading, or even if you've been a trader for a long time, it's a good way, again, to kind of get your feet wet without risking a lot of money. Now, I'm a firm believer that paper trading is not only beneficial, but it's an absolute requirement of successful trading. And to be honest, I still paper trade new ideas. I do the bulk of my trading with real money, but if I have a new idea or a new way of doing things, I might paper trade that strategy for a couple months and try to test it out a little bit before I actually put some real money to use. So here's my two biggest problems with paper trading for beginners. And I think this really kind of encompasses a lot of different things that really kind of hinder your ability to make the leap between paper trading and real money trading. The first thing is that it teaches you to do things you normally wouldn't do with real money. And this is really the number one thing for me, because with paper money, you usually get this account that's, $100,000 of paper money. And it's just not realistic, right? And again, it's paper money. You know that it's not real money. So you end up making trades that are more aggressive than you normally would. You end up getting out of trades maybe slower than you normally would. And it really doesn't teach you that much because you don't have real money on the line or kind of skin in the game. So that's the first thing, is that it doesn't really teach you what, it teaches you to do things that you normally wouldn't do with your account. Number two is that market fills and pricing are instant when you paper trade. Now, this is true of the Thinkorswim broker platform. Their paper money account, when you enter a trade, as long as the market's open and your price is very close to where the market is trading, you'll instantly get filled and you'll instantly get filled at your price. Because again, it's just paper money, so they don't really care about real fills. But when it comes to real money trading, market pricing and fills are extremely important. In fact, we did a huge tutorial on just how much money you can lose on slippage, not trading liquid products. And it's amazing the difference that people tell me about when they go from paper money trading to real money trading. They think that they can get in and out of all these markets really quick and at great pricing. It's just not the case. So I think that's the number 2 thing on my list here, is because that makes a huge difference in your ability to be successful, is the ability to get in and out of things quickly at great prices. Now, that said, everyone can read about trading or take a course on trading, but until you actually open up a real money account with a broker and start placing orders, you will never learn exactly how it works. And this is what everyone always talks about, right? You've got to, as the old saying goes, there's no substitute for seat time. The more experience in the education that you have, the more profitable you will become as a trader. And that doesn't mean that you have to, just start out investing all of your money, but putting some money at risk is a really good thing, because then it ties your emotion into the game, and that's really important. So here's a couple tips I have for paper trading to do it right. So if you are going to paper trade, you want to paper trade, which I think is a good idea, let's make sure that you do it right. And so here's my top 4 tips. Number 1, resize your paper money account down to mirror your own account. I think it's insane that when you open up a paper money account that you start trading with $100,000 or $200,000, because you can set whatever price you want. What you ideally should do is resize that paper trading account down to what you're actually going to trade, or even less. And then if you can make money with less money paper trading than you actually have in your real account, then you're probably ready to make that jump over. Number 2, automatically reduce fill prices by $5 across the board. I mean, I would even say if you can successfully do it and reduce prices by $10 across the board, that'll give you a little bit better idea of what will actually happen in the market when you go to real money trading. Number 3, you've got to stick with the system and treat it like real money. Now, I know this is really hard because it's paper money, it's fake money. So my tip here is make a side bet with your spouse for competition, or a brother, a sister, a friend, a coworker, it doesn't matter. Make a side bet between you two, and they don't even have to be traders. Just say, hey, look, I'm making this bet. I'll bet you $100 at the end of 6 months I have more money in my paper trading account than I had to begin with. And that's really all you should be doing, is just trying to make a profit or even turn everything over and stay even in your account as you get started. But helping to do that is by making that side bet with a spouse or somebody else, again, a brother or sister, a coworker, to keep you accountable to the system. And number 4 is you've got to put real money at risk sooner than later. So while I suggest absolutely that you have to start paper trading right away if you're a newbie or even somebody who's been in the business a long time and starting to trade new strategies, I think that at some point you have to put real money to risk, even if it's only $100 or even if it's only $1,000. And so I really say, you know what? After you've paper traded for maybe 2 weeks or 3 weeks as a beginner, you really have kind of the system down and the basics down, go ahead and put some real money to work. Open up an account with $1,000. That doesn't mean that you trade all $1,000, by no means, but maybe you can make small directional trades that are $50 or $30. There's very small trades that you can do where you get a little bit directional, you've got a good risk reward, and that's how you get started in the markets and make that leap from paper trading to real money trading. So as always, I hope you guys enjoy these videos. If you have any comments or questions, please add them in the lesson page below. And until next time, happy trading.
Hi, this is Kirk with Forex Strategy Secrets. Just want to share with you a little strategy. This is a short-term strategy that we use. Now you notice that I've marked some vertical lines here. Now this is in history because the market is closed at the time that I'm making this recording. But you can tell when this indicator turned blue right here that was a change from red to blue. So we start looking at that. So this is on a 1 hour chart. Now I'm going to go to a 15-minute chart. That's what you're really wanting to trade, is the 15 and the 5-minute here. But we're trading in the direction of a trend of a larger time frame. So we don't know how long that's going to last, but we know that anytime that the market turns up, we want to buy, then that's what we're going to do on a shorter time frame to time our entry. Go to the 5-minute, the 15 minute, and here's an alert. Now this alert started clear down here, it just rolled up as that bar formed. But so you're taking buy signals. Total was about 25 pip move, so you could have taken out between, around 10-15 pips for sure on that one before it came back on you. Now you're still looking for buy signals, so you don't worry about taking this short move here, but you start entering here, and there's a good 20 pip move on that. This is on going for a 15. Now let's actually time our entry better by going to the 5 minutes. So you could go from the 1 hour to the 15, but usually we're really looking for the 15 and the 5 is where we want to time our entries. So we have I got a good 20 pip move if you went to the 5 minute, and you see you're taking the same two trays. This is almost 25 pips that you could have had on some pretty straightforward moves. Now let's go back to the 1 hour. That was during a time the market really wasn't moving all that great. Now let's even go to a time when it's even less movement right here. Now we're still on the 1 hour chart, and we're just looking at this little area right here. It only went up for a couple of hours and then started coming down and went sideways for a while. That's the 1 hour, so you're looking for the trend. The strategy is to then, once you know what the trend is, to go to the 15 minute. Okay, and here's another signal to get in. And we know these are short moves. That was only a 10 pip move, but that's all we're looking at in a sideways market like we're seeing up there. But here's what the 5 minute looks like. You're waiting. You don't trade just because the 1 hour changed. You wait until you get a signal on a smaller time frame. That was a 13 pip move. Now let's go back and look at the 1 hour again. You can see that that wasn't during the time that the market was moving much at all. But we know the overall trend is up, and so we kind of check that on a 1 hour. If the 1 hour is going in the right direction, then we take the trade. So hope that was a help to you. Find the trend on the larger time frame and go and time your entries on smaller time frames. We have alerts and signals to be able to show you how to do this.